Joining us. My name is Matt Rogers, and I'm a manager in the financial planning group here at eMoney. Today, I'm joined by my colleague, John Costello, the senior financial planning analyst in that same financial planning group at eMoney. This month, September, is Life Insurance Awareness Month, and we thought it was the perfect time to discuss some of the dynamics that clients and advisors face when discussing life insurance. In addition, we'll show you how our newest planning solution, foundational planning is called, can help you scale your planning needs in general. And specifically today, look at how foundational planning tool can help you set up the life insurance conversation and get you a quality, personalized analysis for your clients. So today, what we'll cover is number one on the agenda is household misconceptions about life insurance. Number two, where life insurance fits into the general planning process. Number three, and perhaps most interesting to this group, will be learn a little bit about our new foundational planning tool and specifically see a demo of our brand new life insurance analysis inside that tool. And then lastly, we'll close with a Q&A. So why households need insurance in the first place, as if you guys don't know. So let's talk about why life insurance is important. A 2018 LIMBER study found that half of all households surveyed would feel financial adversity from the loss of a wage earner in just 6 months. Even scarier, a third of households would feel financial impacts within 1 month of losing a wage earner. Those are scary statistics and speak to the importance of talking to clients about their life insurance coverage. In fact, maybe the only scarier stat is the 16% who don't even know how long it would be until they felt the pinch. This tells me they haven't even thought about life insurance and family protection. Now, I suspect that based on these stats, most of the people in the study probably did not have a financial advisor to make sure they would be adequately covered. For example, I'm sure your clients would not feel the pinch in 6 months. However, when you find new clients, this may very well be the situation you'll encounter. And it's a good reminder to just not overlook that insurance conversation very early in the relationship that you're building. Don't assume they are properly covered and jump right into the admittedly more fun conversations like how to invest better and the more fun things that you can do for clients. So everyone on this call knows that using life insurance is a pretty simple solution to the universal problem of family protection. So why do, as we just saw, why do so many households not take that solution or take it to the proper degree? Number one, 63%, they think it's too expensive. And we all know that's a misconception. Term insurance, has never been cheaper. You can get 30-year term for under $1,000 a year. 10-year term for under a couple $100 a year. Even permanent policies are as competitively priced as ever. So we all know that's more of a misconception, but it's out there. The next reason is they have on this, this LIMBER study is they have other financial priorities, 61%. This to me sounds like a simple lack of education on the part of consumers out there. These results are driven by consumers who don't have advisors helping them. What could be more important than protecting your family's financial future? So again, when meeting new clients, remember these statistics and make sure their priorities are in a sound order. Family protection trumps saving for that mountain cottage, or it trumps saving the extra $100 a month into a 529. And $100 a month may be much more valuable buying extra coverage to protect the family. Lastly, the last reason is 52%, they have as much as they need. And I hope that 52% is actually correct for their own sake. I heard a saying a long time ago from a financial advisor, a friend of mine, and his quote is, quote, "I never had a surviving spouse tell me that he or she had received too much insurance. It's never happened and never will," end quote. Now, I'm not arguing for gross overinsurance, don't get me wrong, but with the affordability of term insurance, there really is little reason to not err on the side of a little overprotection is the way to err. I think that a lot of everyday people don't really understand how quickly the costs add up of sending 2 kids to college. That right there could be approaching $500,000, if not more. Cost of daycare, cost of just operating a household without the help of the other spouse. Everyday living expenses, roof fixes, car fixes. You get the idea. The $400,000 policy they think is adequate is really not going to accomplish much. And you may have the critical opportunity to demonstrate that to them. And we think our new foundational planning tool, which we'll see in a little bit, will tee that conversation up and show them that oftentimes what they think is adequate may not be. And if it is, then that's reassuring to know that it truly is. So think back a slide to the reasons people don't buy insurance, and number 1 was too costly. Over 50% on the slide here, over 50% of responders in that 2018 survey thought life insurance cost 3 times as much as it really does. Again, consumer misconception, lack of having an advisor shows them the proper details. So there seems to be a lot of misunderstanding about life insurance, what it costs, and how much is really required to truly protect a family for decades. So how can you as advisors and we as your partner in this situation help this cause? Number 1 is we feel make life insurance the foundational part of a plan. So it starts with life insurance being a foundational part of the plan. It should often be the first topic you discuss with clients. Discuss it before education planning, before retirement planning, before investment ideas. The extra savings into a 529 or that change in allocation that you could suggest, and rightfully so, will certainly help long-term goals, but it won't help tomorrow if something happens to the clients today. So protect tomorrow first. Make sure the client's children are protected first and foremost. And lastly, think holistically beyond just children. Do the clients have other people dependent on them? Elderly parents, a special needs sibling? The ability to protect key loved ones, not just children, is not difficult nor expensive in today's marketplace. And you all know that. I'm not so sure consumers know that. The other thing that I think we can all do is to help clients understand the realities of losing a partner. It takes some imagination, and yes, it is a bit of a hard conversation, but to open up that dialogue can offer a much better solution. For example, would the survivor work? Oftentimes, this depends on the ages of the children. Perhaps the surviving mother would not want to work if the children were 2 and 4 years old. But ages 14 and 16, perhaps she would want to work part-time. Everyone's different, but the solution of insurance and how much is needed will depend on understanding what the client would likely do or not do if that situation were to truly be imagined and not just glossed over. The worst thing is to have this happen and have a survivor realize after the fact that she wants to stay home but can't. So try as best as possible to identify the expected behaviors or preferences in this unfortunate event were to happen, so that you can bake those proper situations into your analysis and get the right answer for each client's individual preference. And again, we think our software will help with those conversations, and you'll see that shortly. Likewise, besides just working more, working less, would any goals change? Does the second house in the mountains still hold appeal if one of the clients or spouses were to pass away? Would new goals appear? Perhaps the addition, perhaps on top of all your regular costs, you want a daycare cost so that you could go back to work or stay at work, a nanny, home repair goals. So a lot of times costs will actually increase in these situations once you tease out how the client or spouse may react to being a surviving spouse. Listing out all these certain goals, these individual goals, will also help the client understand the itemized costs and then in turn understand the full cost of running a family for decades with only one or possibly no wage earners. So thank you for all that. I'm sure none of this is new to all of you, but it is good to think about these things now in September, Life Insurance Awareness Month, and remind ourselves that so many people out there get this aspect of their financial life wrong for any number of reasons, ranging from, as we said, incorrect cost expectations to improper priorities of long-term, more interesting goals over the dry goal of life insurance protection, to simply the incorrect belief of what it actually costs to run a household. So my partner today, John, will show you our new life insurance gap analysis, and many of the features in it address these very same talking points. So like being able to identify new goals or remove goals, change survivors' work expectations, etc. And at the end of the day, you'll see that you can produce a accurate, customized, and yet simple gap analysis using our new tool. So at this point, I will hand off to John.
Great. Thanks, Matt. So today, we're going to be taking a look at our solution for life insurance as part of our foundational planning offering. Back in February, we launched the foundational planning product as an experience designed to both support clients with less complex needs and help advisors scale their planning. By simplifying and streamlining the plan building experience, foundational planning allows you to address a client's most essential needs and goals through an easy-to-follow guided workflow, allowing for plans to be created more quickly and consistently. With all that in mind, we designed our life insurance gap analysis module within foundational planning to follow that same philosophy. As Matt mentioned earlier, conversations about protection are very important, and through this module, you can quickly and efficiently get that discussion started through 4 simple steps. In the event of an untimely passing, you can answer these 4 questions. What are the survivor's immediate cash needs? What future goals do they have and what are their income needs? What resources they already have available to them? And ultimately, how much additional protection do they need to bridge that gap? Before we hop in the tool, I just want to take a minute to introduce our case study for the day. So please meet the Stevens. Katie and Tim are successful 30-somethings who have accumulated about $1 million of net worth thus far. They're both high earners. They have 2 young children named Ava and Jack, and are concerned with saving for not only their retirement, but their children's educations as well. The Stevens are also concerned that if one of them were to pass, they are not adequately protected to make sure that the other can be comfortable and that their children will be taken care of. Now let's hop into the tool and take a look. So what you're looking at right now is the introduction page. The first page of this analysis will give you a warm introduction to the module and outline the workflow. As we start talking to the Stevens, we're going to first identify their needs, both immediate and future, review their current resources, and then analyze their gap. You'll also notice towards the bottom that the assumptions being used for life expectancy and retirement are outlined as well. The system will assume a premature death occurring in the current year for the subject of the analysis, but should you need to change the survivor's life expectancy or assumed age of retirement, you can do so through the profile link here. Our next step is to identify what immediate cash needs Tim and Katie would want to make sure that they are taken care of. The first need we're going to want to address are final expenses. Some things to consider when inputting a number here are funeral expenses, estate administration fees, any outstanding income tax, property tax, medical expenses, essentially anything outside of paid off liabilities that you want to be taken care of in year 1 following death. We'll put in $50,000 for now. Next, the system is going to ask us which outstanding liabilities we would want to be paid off. You'll see we have a mortgage here, and we have an option to pay it off at either Katie or at Tim's death, and we can simply check this on or off, and that will either include it within the analysis or exclude it. You'll notice that you can make different selections for both the client and the spouse depending on their situation. So if one spouse is a particularly higher earning than the other and you don't necessarily need to take care of the mortgage, then you could leave that one off. They can pay it down normally for that particular client, but then maybe for the spouse who's earning a little bit less, it's a little bit more of a concern that that gets taken care of immediately. Now that we've taken care of the details of what happens immediately following death, the system will prompt us for some information about the rest of the survivor's life. We'll start with their living expenses, or in other words, their income need. Some important things to consider when inputting these values, you'll see I have $200,000 for both pre and post-retirement for both Tim and Katie, is that they should not include any payments made to liabilities that you opted to pay off in the previous section and should be gross of taxes. Another important thing about the survivor's future needs are their goals. As Matt said earlier, one of the difficult questions can be, are goals going to change? The reality may be that if a wage earner were to pass, the survivor may not be able to achieve every goal they have. Here you can elect to exclude goals from the analysis for either the client or the spouse. So you'll see we have two different education goals. When we were talking about our previous clients, we know that education for Jack and Ava is very important to them, so we're going to opt to include these. But if for whatever reason you wanted to remove these finite expenses from their plan, you can do so by checking this off for either Katie or Tim. Now that we've identified their needs, the last step before we review the Stevens protection gap is to review the resources that they currently have available to them. This page will list all insurance policies, assets, and incomes that are used in the analysis. Should you need to change any of this information for whatever reason, if there's an income that you forgot or you need to adjust the salary if Katie's going to go to part-time or something like that, then you can there are convenient links to the appropriate areas in the fact finder in order to change that information. So now that you heard me rattle on for a little bit about what the inputs are, let's take a look at the actual results. So this page is going to walk us through the amount of insurance needed for both Tim and Katie in the event of either of their deaths. The table that we see here on the left side will summarize the math for us. The first two rows are going to lay out our need. If Katie were to pass, we can see that Tim would need about $3.6 million in capital. About $350,000 of that is going to go towards immediate cash needs, and the remaining 3.2 will go towards future goals and expenses. On the other hand, for Katie, we'd only need about $3 million or so. The next two rows are going to restate the capital that they already have available to them. So this is going to be the information that we just saw on the current resources page. And we can see that for Tim, we have about 1.1 million or so, and then we have about 1.3, 1.4 for Katie as well. So this is really what gives us our gap. So we know how much they need, we know how much they have. As you can see, based on this information, Katie needs about 2.46 million more of life insurance, while Tim needs about 1.6. This is all assuming that those proceeds are going to be reinvested into an income portfolio growing at 4.93%. If we wanted to change that value, we can do so with this change reinvestment rate button here. This will give us a list of model portfolios that we have input in the system that we want to show those proceeds being reinvested into. To the right, you'll see this information visually represented as well, with the needed capital represented by the bar on the left, and the available capital and ultimate insurance gap represented by the bar on the right. For more detail, there's also a full illustration located at the bottom of the page. This table shows us that additional insurance in action by showing how that additional capital gives their portfolio the staying power to sustain drawdowns for expenses not covered by income. So from left to right, we can see for every year in simulation until Tim is to pass away, what his beginning of year portfolio assets or investable assets would be, how much growth he's going to get on that portfolio, how much expenses he has related to just annual survivor costs, any goal-related expenses, any income that he has coming in, and then the ultimate drawdown on the portfolio or the unmet need, and then finally the resulting ending portfolio assets for that year. So it's more or less going to give us a full cash flow illustration of what each spouse's situation would look like were they to receive that actual new insurance and invest it at the chosen rate. You can swap between which client you would like to see this illustration for by clicking these buttons up in the top right. So if we wanted to see Tim, for example, we can see we get a different illustration here. There is also a printable version of this report, which is available in the presentation, which you can access by clicking on the Plans tab and then clicking the Go to Presentation button, which is going to mimic exactly what you see on the screen here. So this really concludes our in-app demo portion, but before we head into the Q&A, I wanted to touch briefly and give you guys a little bit of a sneak peek onto what's coming next in the module as well. Coming soon, we're going to be adding an effective tax rate field so that the future needs input area will support both a more traditional expense-focused analysis as well as one more focused around income needs. So if you don't want to be inputting annual expenses, gross of taxes, and you want the system to calculate some taxes for you and just worry about other types of expenses, that field's going to be available soon. We're also adding the ability to add and remove insurance policies, assets, and incomes from the current resources screen for the purposes of the gap analysis only. So this will not impact FactFinder, but will allow for more flexibility in the tool by giving you the ability to show alternative situations like what if the survivor couldn't work and you wanted to remove an income, or maybe they could only work part-time, so you wanted to add some part-time income, things along those lines. So just give you a little bit more flexibility and let you show it through a different lens. As well as allow for the analysis to be done without going through the traditional FactFinder experience for prospects. So if you don't want to go through FactFinder and fill all that information in there about, accounts and things like that, and you just want to do a quick analysis for somebody who maybe you have limited information on, you'll be able to add some accounts and policies and things from that page. So you'll still be able to get a gap analysis done. And we have many more coming as well, too. Not anything else that we're quite ready to share details on yet, but we have a lot planned for this tool, so stay tuned. And with that, I will open the floor up for questions. Thank you very much for attending, by the way.
So it appears we have a healthy dose of questions, so we thank you for your questions and paying attention. So looking at some of the list here in no particular order, so of priority, just which ones I can sort of get to first, or John as well, if you have anything to say to these questions, chime in. Somebody asked about the link to a LIMRA study, and that we have that available, correct? So that's sent out, so you all should have the link if you are interested in that. Another question was about, pardon me, was this tool uploaded into all versions of eMoney, or do broker-dealers need to approve this new tool? So the answer there is, if you are on our quote-unquote street version, you have it automatically. If you're part of one of our enterprise clients, then the standard rules apply. The enterprise has their 2 or 3 approval periods each year, and so this will be part of that next coming up process, and we expect no problems with getting this approved. But yes, you may have to wait a little bit longer until your enterprise partner officially turns it on. But I see no problems with that happening.
Have just a navigation as far as how to get to this page from the home page. So this is going to be located in the Plans tab. So once you've opened up a client and you're on the client homepage through the overview, all you need to do is click Plans up in the top right here. And then down the bottom, there's under Additional Topics, you'll see a box which says Life Insurance here. So you just need to click that, and that will take you to the module.
And let me also clarify my prior answer about enterprises. Just a reminder, this is a new tool in the foundational plan. This is a new feature in the foundational planning tool. So as long as your enterprise has the foundational planning tool as part of their eMoney application, then my answer applies. If for some reason your enterprise doesn't want this tool, then obviously it's a moot point at that point. Just want to clarify that. Thank you. Somebody also asked about when entering, and John, if you can show it maybe, if you can, when entering final expenses, giving some information about typical costs and that kind of stuff. which was actually something we discussed when we were building it. We didn't know how typical would be, to be honest. But we do have a link there that gives you what are final expenses. So it'll give you some things to think about. But as far as typical costs, we didn't quite go there. We certainly could. That's a good idea. Maybe you'll see it in the future. But for right now, we just didn't know how typical, estate costs are across, the breadth of clients out there. So, but there is a bit of a help guide there. And through this tool in general, you will see various tips and assistance tips throughout each page as well. And we'll be adding, as John said, this is just our version 1. We think it covers a lot of cases, but we want to give you more flexibility. John mentioned a few of those things that are coming, as well as more tips and more ways to help you navigate through. But we think as is, you have a very simple workflow here. So hopefully questions will be minimal at best.
We also have a question on whether or not if a client is under 59.5, if we state 401k and other qualified incomes as assets. So the analysis does span both pre and post-retirement. So we do include retirement accounts and qualified income as well. Those will be included as available assets.
And our basic order of liquidation is to take insurance money first to avoid those kind of problems. So it should be a very unlikely scenario where 401k is being tapped at age 43. We make sure to use insurance money first in our behind-the-scenes logics. There was also a question about other risk analysis, such as disability, and that's a great question and a perfect answer, perfect segue to this is a new tool, foundational planning. It's only a few months old, really. This was our first big addition after our first release. And yes, we anticipate adding other modules like disability, like long-term care. And the ultimate vision is that, just like what you see here, you can do a single module by itself, like life insurance. As John mentioned, pretty soon you'll be seeing these buttons where I can just add a quick, what's my total account balance, just in the module only. So I don't even need to do a fact finder. It can be a limited modular only situation. The same thing would be true for disability or for long-term care, or get all the data in the fact finder and then all these stories combined together for a holistic plan. This tool should be able to satisfy both requirements: individual analysis at a quicker level, or combined analysis, holistic analysis at a little deeper level. So that'll all be part of the game plan, and you'll be seeing other other topics rolled out over time. Right now, disability has no time frame, but it absolutely is on the roadmap to move this foundational tool in the right direction and become a holistic tool for all kinds of planning situations. One more question I see here is how do you address employer-based group coverage and the risks that exist from switching jobs, passing along costs to employees? So when our vision here is if you have a employer-based, you put it in here as a current resource and as part of the math, right, as of today. I don't think there's a storyboard here for the risks of changing jobs and losing that. What you could do is, once we build some extra flexibility in here, is remove that death benefit, right? And say, Mr. Smith, Mrs. Smith, what if you left your job, right? Or you lost your job involuntarily? That $180,000 policy won't be available. So you will be able to turn things off and on. And in this case, you would turn one off under the idea that you wouldn't have this because your employer could let you go, and there's a reason why you should buy more insurance that you should personally hold. So yes, you could remove employer coverage from your analysis and encourage a higher amount of personally held policies, and that math would work correctly as long as you turn that employer policy off. That's all part of the things you should be able to do in this module.
I also see we have a question related to what-if scenarios, so regarding whether or not the advisor would be able to tweak the needs to present different options to the clients. So that's part of what we're looking to release shortly by giving you the ability to add and delete things from the current resources page. So this will allow you through adjusting some of this information to run some of those what-ifs. So, you know, what if somebody worked part-time or something along those lines. I do think it's a great point to look at addressing some of that functionality in some of the needs areas as well. And that's definitely discussions that we're having. But for the time being, you will be able to very shortly add and remove things from the current resources page to help you model some of those what-ifs.
I see a question here. Does eMoney have a stance on the report used for life insurance, human life, or gap? I'm not sure what that means. I'll take a little bit of a guess. Human life value versus gap analysis. If I'm wrong on what the intent is, I apologize. But yeah, this methodology here is more of a needs gap analysis, right? You tell us what you need ongoing, both every single year. I think John had 200,000 plus your goals, and then what you have is your income and your assets, and we do a goal level analysis of how long can your assets last to pay all these goals. It is not a human life value where we're just replacing income regardless of the size of the goals and the cost. So this is a needs-based, a needs goal-based methodology. And if that was not the answer you're trying to get to, apologies.
I also see a couple questions about tiers of licenses. So just as a reminder, in general, this gap analysis module that we went over today is part of our foundational planning offering, which is available as part of both the Plus and Premier product packages. So if you have any interest in finding out more information about that or a demo or anything, we can follow back up with you after the webinar and schedule something.
I think we've run through all the questions. If anybody wants to put in a last question or two, absolutely feel free. John, do you want to, in the meantime, just do a minute or two on foundational versus advanced planning or anything in that genre of knowledge?
Sure. So the foundational planning, which is where we spent most of our time today, is really a simpler and more streamlined planning experience than our traditional advanced planning tool. They do communicate with each other, so a great way to really evolve a relationship with your client is to start with a foundational planning conversation, really get some of the basics in there of, you know, what are your essential needs? Let's have a discussion surrounding that. Let's talk about your protection. Let's talk about really nuts and bolts of what you absolutely need for your retirement. And then from there, if your relationship deepens, then you can move on and graduate, quote unquote, graduate that client to advanced planning. And so while the foundational planning workflow and input experience is a little and focuses on some more high-level data as opposed to the advanced fact finder of advanced planning, they run on the same engine. So foundational planning clients are communicative with advanced planning clients, so on and so forth. From a life insurance standpoint, the human life value and the gap analysis question in particular is rather interesting because we actually do offer a human life value report as well as a traditional gap analysis in our advanced planning tool. So while the foundational is focused primarily on a gap, the advanced planning does actually offer both. And that's really a theme that you'll see between advanced and foundational planning, is that foundational planning is really giving you a guided workflow and helping you walk through each one of those discussions and kind of giving you the tools that you need to talk about them. And then the advanced planning gives you everything else that you wouldn't have in foundational planning. So if you did want to approach it from human life value, you've already talked about the gap and you want to look at it from a different angle, that's a great reason to graduate a client to advanced planning. You can take a look at that human life value report. You have some more detail in your gap analysis. It's not quite as high level. There's a little bit more of a window into the math behind it. So while you're really getting the same quality of outputs, the advanced planning is just giving you the ability to dig a little bit deeper. While foundational, we're really curating the results that you see and curating what you're showing to your client and helping you have that conversation and guiding you along the way.
And the last thing I'll add is even though foundational, we think it looks really easy, it flows nicely, it seems very simple, there is a large amount of horsepower behind the scenes. As an example, you saw John when he had a key assumption of what will this new policy, I think it was $2.4 million for one of the clients, what will this new policy, earn? Obviously, the more you earn, the less you need to have of it, right? But every other asset that already exists all has, each asset has its own unique growth rate. So this is not one of those things where all things earn 6%. If you want to have different assets that already exist, 401k for him, for her, IRAs, they can have different growth rates pre and post. We honor that. If you have an IRA and the beneficiary is not your spouse, that money won't appear here. The system is smart. It has horsepower behind the scenes. It just looks really nice and slick and easy and is up front, but you'll be getting meaningful results, not just internet-free calculator type results. So have faith in that as well, that this will be very personalized and robust math despite the seeming easiness of the UI. So John, you want to close it out?
Sure. Yeah, so first and foremost, thank you everybody for joining us today. We really appreciate it, and we had a really engaging questions and conversation at the end, so that was awesome. So thank you to everybody who came. That's going to conclude today's presentation. Just as a reminder, there will be a recording of today's webinar that will be emailed to you next week. And if you have any additional questions or you want to sign up for a demo of foundational planning or anything along those lines, please contact us at 888-362-4612, and we'd be happy to get you squared away. Thank you, everyone, and please enjoy the rest of your day.